Hey guys, thanks for showing up today. I wanted to start out the year from one of my presentations. I know we've done a few on Columbus, and again, the cheap shameless plug is we do have a contest going on right now for first quarter with Columbus, one of our product partners. If you submit and place $15,000 in production with Columbus within the first calendar quarter, so January to, well, we put the end of April, we will have the ability to bring you to Cincinnati. We'll spend a day at Columbus's home office in Cincinnati, and then they'll also treat us to a Cincinnati Reds game. They're playing the Pittsburgh Pirates, and it should be really fun. It's in the middle of June or the latter part of June. So would love to have you guys there. But again, that was what we had in the beginning of the year. And then what we're going to do today is we're going to talk about a sales idea or a sales opportunity. Now, I'm going to try this at first and see if this works. I want to launch a poll and ask you guys a few questions because policy review can seem so remedial, but I'd love to hear what you guys have to say. So if you see the poll questions, the first one is how often do you speak to your client? We got monthly, annually, sporadic, or are you a churn and burn kind of person? You know, you write the sale and then you're gone. And then also the other one is, do you review the enforced policies regularly? So I'll keep this poll up for a little bit because when you think about what it is and the idea of the policy review, this is, believe it or not, your key to success. So a lot of people in the industry don't realize it, but this is how you enhance your value, enhance your practice. And ultimately, what do people always talk about when they're getting into the industry? What's the biggest thing that people have a concern about is leads, is getting to the next step with your client, is getting additional clients and additional revenue-based opportunities. Now, one might argue that policy reviews are not a huge value proposition per se, but what it does intrinsically with your client is that it allows you the chance to continue that partnership. So I see the posts. We got sporadic for meeting with people, a little bit for annual, one for monthly. Kudos. And then we got a 50-50 shot with do you review the enforced policies regularly? So, oh, we got some more votes coming in. So I'll leave this up just for giggles as we go through the process. But let's dive into policy reviews. So we're going to talk today about reasons really why you would want to do a policy review from the standpoint of things like life changes. So simple things in a life change could lead to a big impact and more questions. Pricing. So as we all know, pricing changes consistently in the industry, and it's so important for us as people in the community who is taking care of the community to stay on top of things like pricing. And then how do we as professionals help our clientele ultimately get what they're looking for from that standpoint? So I'm going to close the poll here in a second. If anyone wants a last minute click or two. 3, 2, 1. Okay. So results, I don't know where they're showing. If not, they're right here. So we have quite a mix. Sporadic seems to be the winner, and roughly 50-50 shot for reviewing policies regularly. So pretty interesting results to say the least. I appreciate the honesty too. And I was hoping someone would say churn and burn, but whatever. It is what it is. I'm glad no one did, I'll be honest. So let's talk about reasons for a policy review. Have your clients been married recently or divorced in the last several years? Those life changes can automatically trigger a reason to talk to your clientele again. Have they changed jobs or been promoted? So interesting fact, like if you think about it, I'll use myself as an example. I was making X at AIG. Now I'm making XX as a business owner. Do I need to revisit my own policy that I got? Absolutely. Now, there are other things that are in that as to reasons why I haven't gotten additional coverage. I'll just say, thankfully, it shows shoulders and up when it talks about underwriting, but that's a different story for a different day. Have you started a business? You're sold one and retired. So, have you gotten kids? Have you become a parent per se, or even a grandparent? So, when we think about legacy planning is so big. And really, I'll be honest, like my parents moved to Tennessee, not because of me, not because my sister also with her family moved down. It's the six grandkids that are here and they want to see their grandkids. They could care less about me. They love their grandkids. So when you think about that value and what we like to do, our stories are heartstring stories. We tug on the heartstrings. We find the problems that they have that they don't know they have already. And one of them might be leaving a legacy. And what's the best way to do it? Leveraging life insurance to give you a better bang for your buck. How's the death been experienced? A lot of times, if you think about COVID timeframes, everything spiked when it came to awareness of life insurance because everyone had that mortality conversation. We were locked in our houses for whatever reason, and all of a sudden, people now had that thought in their head of death. And so there's that idea that how do I protect myself? How do I protect my family? When you talk about refinancing your house, when you talk about purchasing a new home, a second home, mortgage protection. So all of those life changes, if you think anything that changes, job change, add kid, subtract kid because they moved out to college, loss of a family member, gain a family member, and then again, you think of job changes, divorce or marriage, things like that. All of those are life changes that you really want to have that engaging conversation with your customers. So that leads to conversations. What we would say is at least annually. Some people do it semi-annually, but the idea there is that it gives you a hook or a tie-in to continue engaging with that client. Now, another thing is why do we stay on top of the industry changes? So I'm looking at the people here, we've all been in the industry for at least 4 to 5 years. And we've noticed that there was with Index Universal Life, there was the AG 49 rules, AG 49 rules revised, 7702 came out to give you more money in smaller policies to give a higher cash accumulation. So pricing and things have changed. And what could happen is on the other side, you have term where the pricing on term has consistently come down because it's a tough competitive market. Typically, you'll see five carriers at the top. I call them termites, brokerage AIG or Corebridge, so select a term, protective, John Hancock can be, but Banner, Pac Life, and Symetra are usually those top carriers that you'll see, but they're up there for a reason. It's all pricing. They're giving you the cheapest possible price. So if your client bought, say, a company, mom and pop, company, or I'm not going to pick on them, but say like a State Farm. State Farm doesn't really have price competitive products, but what they have is that relationship with the client. They bought auto, they bought home with them. Now they're going to buy a life insurance policy. Why? Because they asked for it. But if you reviews that term policy, you might be able to sell them a more cost efficient policy, something with living benefits. So you have that conversation around pricing and how the designs change, how underwriting can change. We worked with a client who was declined a few years ago for some type of medical reason in underwriting. Well, because time has moved on, we were able to get them approved. So you have those situations as well where things can change. Maybe they were a smoker, now a non-smoker. We can shave 50% off the cost right then and there. So a lot of those pieces are very important when you're talking with your clients and engaging with them. And so really, how does it boil down to how we can help? So first off, we have to identify policies. And then when you say that, there's a way to analyze the policy. So for example's sake, if I was talking and engaging with a client, say they had a New York Life policy, for example's sake, not picking, just saying, what do we look for? We look for cash value, we look for face amount or death benefit. This is part of the analyze part here. So moving from identify to analyze, we look at what they're paying, how long they're paying for, and if they have any health related issues, that's the concern that we have to understand is what is the health related issues that might take place. Because I've had some cases where they were standard before, now they might be a table D. So we have to analyze all of that when we're looking at our policy reviews. The big one is potentially improve. So what do we mean by that? There's usually three things you look for when it comes to a policy review. Can I take the same premium, move the cash value that's inside the policy to a newer policy and improve the death benefit? Or can I take the same face amount that they currently have, move the cash value over from their old policy to a new policy and reduce their premiums, maybe even stop their premiums, which would be the third option, which is reposition that 1035 exchange of cash only and see what it can buy. Puts more money back in the client's pockets so they can use it how they may. Um, and then ultimately manage. So once again, it goes back to us doing what we do best, and that's taking care of our clients. So what I would highly recommend is if you haven't done this, then I would highly recommend when you sell a policy, put on your calendar an annual reminder that that statement is coming due, because the carriers have a hard time doing that or sending you in-force illustrations or statements. So you have to take it into your own hands to manage those policies. And so I'll give you an example here because it's always important to understand what we're working with. So this is a case you're looking at where we had a 48-year-old female. She is married and they have two kids. Currently, she has two policies, one with New York Life and one with John Hancock. And if you'll see, the issue dates were in early 2000s. So in 2001, the operating policies were on a older mortality table. I'll get real technical for a sec. It was called CSO 1980. They assumed that in the old mortality tables, you were going to pass away no later than age 100. Well, in the mid 2000s, they increased it up to a CSO 2010 table, I believe it is. Don't, or it might be 2000, I don't remember. But it increased the mortality age up to 120. So that can actually reduce your annual cost of insurance. And what we saw here was the client had between the two policies about 1.1 million in death benefit. They had about 148,000 in cash value, and they're paying annually 7,226 between the two. So as you can see, the premium for the whole life was a lot smaller because of the smaller face amount. The premium for the John Hancock policy was a lot bigger because it was a higher face amount. Now, the things that I notice here, a couple things. So first off, 2001, so it's 22, 23 years old now. And you'll see that the cash value inside of the policy for the whole life policy has just barely made it over net neutral. And they're at a loss inside the John Hancock policy after 23 years. So that tells me there's a potential for us to improve on this opportunity. And so given the fact we have 30 carriers at our fingertips, I did a little research and I looked up and partnered with, this is Symetra. So if we use the same premium, which is the 7226 plus the 1035 of about 148,000, we see that we can give them triple the death benefit that they had before. Now, one might say, well, what if that objective is not the same? Back here, we're looking at $1 million policy and $111,000 policy. What if their objective was cash accumulation and not death benefit? Well, we had that conversation with them. So part of the first stages, excuse me, the first stages is identify and analyze. We analyzed that the client had no need for accumulation really for this policy. They're doing A-OK as a family. And so the idea here is how can we maximize the death benefit? And we were able to give them 3 times the amount of coverage that they already had just by repositioning, not taking, but repositioning those assets from one carrier to another using advanced mortality tables and pricing to allow them a better opportunity for more coverage. But we also had an idea to look at. I said, well, why don't we take the same face amount that you had and we'll use the 1035 amount and see what the premium might be. Well, we didn't need that because the 1035 alone of the 148, 459 gave them more, about $500,000 more in death benefit than what they already have. So any way you slice it, we can win. I could put $7,000 back into the consumer's pocket, or we could maximize and leverage that death benefit if they're already paying that premium and they want more death benefit. Either way, we can provide them with something. And so when we think about how policy reviews work, once again, the idea here is to think about those policies that you sold. You might have sold 5, you might have sold 500, or anywhere in between. The fact of the matter is that those are your lead resources, because why? People talk. People want that customer experience. What separates you from a select quote? What separates you from a Xander or any one of those companies? It's your value proposition to continue to stay in touch with your consumer, because they're going to be your best advocates. It doesn't hurt to ask them for referrals at the time of the sale, but also when you're talking about doing a policy review, they might be surprised, because a lot of times people leave the industry and then you have a lot of orphan accounts. So is there a benefit to picking up an orphan account? Absolutely. I actually made a sale just recently off of an account that I inherited from an agent who is no longer in the business. And, it was just a really good opportunity. We reviewed everything. They trust me and they wanted me to be their agent. So I did. And, made a nice little chunk of change there. So those opportunities are available just by reviewing people's policies. And financial advisors are doing this all the time, just so you know. So they're gathering assets. You need to gather assets as well. You need to ask people for their recent statements of their life insurance policies. If someone says, well, I don't have any life insurance, there's a response. Now you take the appropriate action of doing your financial needs analysis, and we can always help you with that as well. If they have it, you got to find out what it is. Can you give me a most recent annual statement? And then that's when we go back to analyze it. But really, the information that we have here today is not going to be advantageous unless you have a call to action. So as I was going through this process, as I was going through some of this information, my call to you is this: what opportunities are you looking for? What opportunities do you have? Do you have a policy that's 5 years or greater? Have you talked to that client lately? Are there face amounts of 250K or more? Annual premiums of 5,000 or more? Any cash surrender values of 20,000 or more? So, there are people on this who have been tenured vets, and that's one of their main sources of income, is talking about policies that they've had in the past. Objectives have changed, and now it's time to revisit those scenarios. Variable policies that were sold in the early 2000s, I could guarantee you those are underwater. Why? Because a lot of independent agents were selling them at 10%, and now you're seeing the individuals sell them at 6%. 8%, maybe max. So the difference in what was originally illustrated to what you see today, there's a concern. Current assumption universal life policies that were sold in the early 1990s, I can guarantee those are underwater. Why? Because after the financial crisis hit in 2008, a lot of carriers increased their rates on those current assumption blocks, and reduce the amount of interest that was being provided. And so if a current assumption product was giving you a fixed return of 8%, now it's giving you a fixed return of 2%. There's a gap there because the policy was relying on that cash value to help keep it afloat. So that's why we have to review these every single year. Otherwise, the policy might go away from what it's doing, and that puts a mar on the industry. So what I would say to you guys is this, definitely feel free to reach out to me if you ever want any help with policy reviews. I used to do about 60 of them a month for financial advisors who knew nothing about life insurance. And I have no problem helping you figure out if there's a better opportunity for them. And we can reposition those clients to a better asset class that's available, better products today versus what there were yesteryear. And we can move forward from there. So that's it on the policy review section. What I will do real quickly too, because I know that that was a very short presentation, I want to also share with you a cheat sheet that I created. And if you want this cheat sheet, let me know. I created it for one of my agencies out in Pittsburgh. Go Ravens. And what it is when we have our carriers that we look at, I look at a few carriers a little differently than the other carriers. It doesn't mean I don't like John Hancock. It doesn't mean I don't like Lincoln, Prudential. I've sold all of them. But when we think about carriers that we want to focus on and why, there's a place in my heart for these carriers, and the reason being is they have a living benefit story, and I have the living benefits here from all the different carriers that are out there. Kind of stole this from AIG. Sorry. But it was public knowledge. I didn't really steal it. I just used it. So gives you different living benefits, the different type of quota that they have. We also have automated underwriting from our different select carriers and how they look at it from a risk class, what they can offer, how it goes through the process, and how much you can get in face amount per carrier. We have different sweet spots. So I do have to update the microsite for AIG because they switched it to Corebridge. So I can update that if you guys want it. But they have 18 different durations. No other carriers have 18 different durations. They have a QOL advantage, which no other carrier has. Very cost efficient, and their IULs are pretty solid. So I still like them. They still have the QOL bonus and trip, and living benefits on all the products, perm and term. F&G only has IULs. That's their story. Solid with the accumulation sales. They have a true non-med, so there is no lab work at all. Ages 60 and below, up to $1 million, but preferred is the best risk class you can get. So they do show highest illustration rates. I'm a big fan of reducing illustration rates down to about 6%, 6.5%. But pretty strong product as well. Quick and dirty, I like to say. Columbus, one of our key partners. The term, not a big fan of selling their term, just because it's pretty pricey and they don't really pay us well. So IULs have healthy targets. They're a plain vanilla product, so they do only the S&P 500. What I really like about it is their in-force block and their new business share the same thing, same pars and caps. You don't see that from a lot of the industry. A lot of the industry will have a high par and cap for their new business, and then it goes to in-force and they drop them. So when you talk plain vanilla in an IUL product, it's a pretty good story to have. And they have a persistency bonus as well, so 50 basis points starting in year 11. But they also have a really cool feature for us as producers. They are the only carrier in the industry that gives trails on the accumulation and growth of cash value. So going back to our conversation about policy reviews, you want to keep that policy in force. You'll get little trails growing on that as well. And those who are agency builders, if you have your agents who sell it too, you as an agency manager get trails on those trails too. So it's a pretty cool story. Like I said, plain vanilla product. And I know some people jumped in, since we started. We are doing a contest with Columbus again, January to end of April. 50K gets you an all expense paid trip to Cincy. to see the home office in June and watch the Reds beat up on the Pirates for a game in the suite. So be pretty cool. They also have a table shave program, 3 table shaves. So ABC get shaved up to standard, so you can actually save your clients some money. I like it because of if you have someone with some ailments, they can get that standard, and they also have living benefits. It's slightly different. They use a lean method or a loan method versus accelerating and completely depleting the death benefit. Allianz, big carrier in the industry for IULs. They're kind of like F&G. They have the rate lock. They do have higher targets than most of the industry. They've been a little tougher to get stuff through right now, especially juvies. I wouldn't recommend doing juvies with them. Um, and But they do have a rate lock. I don't like monthly with Allianz because all the monthly buckets after the first one stay in a fixed account until the next year's sweep. So you just kind of have to look at different carriers for different reasons. NLG, second oldest company in the country, right behind New York Life. Term is competitive, just not as competitive as AIG. AIG is a termite company. North American is up there as well with living benefits. But they are the originators of living benefits. They paid their first claim in the 30s, 1930s. They're the number one carrier in IUL right now. They do COVID. They do an increase of non-med up to 3 million during COVID times. That's what really accelerated them. And then Kaizen was a huge opportunity for premium finance. National Life Group is the number one carrier for Kaizen premium finance. Great for foreign nationals. So if you have clients who have ITINs only, as long as they have ITINs, a passport, and they're paying taxes, you can get with National Life Group, term and perm. You can get it with perm with F&G as well. But they also have retirement plans, defined benefit plans, SEP simples, 403Bs. So a really good story with them on multiple uses. Symetra has a swift term. The fastest they ever got a term placed, 15 minutes from submission to commission, and so it's a really good story. I had one myself in January of last year, I think it was. Yeah, January of last year, client was approved after a day. So it was approved on, sorry, Thursday, and then approved on Monday, standard on tobacco, a 50-year-old for $3 million. This is an online application only. Swift term is quick. I would use this for customers that you have in the real estate market. So if they're looking for collateral assignments and things like that, this is your quick and dirty. And the reason why I like that is for that very reason. Now, if you're looking for something like a conversion option, that's not the one you want. They have another one called like Symetra Term, and it has full conversion privileges. Their accumulation products and protection products are some of the best in the industry right now. Very low costs and pretty good returns. And they have a built-in chronic illness rider inside the permanent policy, up to 50% of the death benefit with no cost for the rider. So I was able to get some pretty liberal underwriting done last year. Also good with diabetics. So I think of Columbus, I think of Symetra for diabetics. So and then North American competitive term, their Builder Plus 3, not a fan of, just because they have those multipliers on their product, and I think you're going to see some concerns later on that you didn't have. Anyway, I won't judge here. We can always talk about that offline. And then their protection builder is good. It's got a dollar guarantee, 2% credit minimum, but that money is already spoken for because of the guarantees. And it is more pricey than QOL Value Plus Protector, but that's simply because they have guarantees all the way to 100 or beyond. So a very unique system. And if you ever want to look up on our 3Mark site under underwriting resources, if you click on underwriting and impairments, you can get carrier specific underwriting guides, underwriting resources, as well as impairment niches. So I wanted to share that as well. I saw a few questions as we went through this. And so I'll stop the recording now for this, and then we'll just kind of dive into the questions.